chapter 13 goes right along with chapter 12 where we talked about compensation, but now we're talking about retirement savings and deferred compensation. And we do a lot of this at VITA. Most of our clients have 1099Rs. Which are their retirement or their deferred compensation. And so there's things you have to look at, when you're working and you're putting money away for retirement, and then there's also tax implications you have to look at once you retire. And it's really important to help individuals plan ahead and know what the tax implications could be. One thing we noticed this year at VITA, which was really unfortunate, the tax reform had a big impact on elderly who were filing single and itemized. I saw at least 10 who came in expecting to get a refund, have gotten refunds for years. They itemize because they have large charitable donations. They're single, widow, widower, divorced, whatever. They're filing single. And this year they owed because the standard deduction went up and it was higher than their itemized, and it's really sad, but that was one of the groups of people that it hit. So regardless of how well we planned and helped them, this year they were caught off guard. So we had to help them understand the changes and how to move forward with that. So I'm going to start with comprehensive problems at the back of chapter 13, and this first one, we have an unmarried individual age 32. And they have an employer-sponsored retirement plan. She contributed $3,000 to a traditional IRA. So things to note, there is an employer-sponsored retirement plan. Questions we have to ask. $3,000 to a traditional IRA. In other words, not a Roth, but traditional. Single, filing single. Jacqueline files, head of household, so she has a dependent. And AGI before the contribution is $43,000. Marginal tax rate is 12%. Okay, so the question is, what is the after-tax cost of her $3,000 traditional IRA contribution? And so people say, well, I can't afford to put $3,000 in there. And we're like, well, okay, but that's not really what it cost you, because there's can be tax savings, can be. And so for her, the after-tax cost is actually $2,440. And the reason is you have a before-tax cost of $3,000. Because her modified AGI, remember that word we used in another chapter, modified AGI, you modify to test for the IRA and for the Savers tax credit. And because her modified AGI does not exceed $64,000, she can deduct the full $3,000 as a 4 AGI deduction. And 4 is usually better. This saves her $360 in taxes. So the $3,000 times 12%, the tax bracket she's in, so she's automatically going to save $360. Okay, and then in addition to that, she qualifies for what we call the Savers credit. And this is really a pleasant surprise. Most people don't know about this one. But the Savers credit has also a modified AGI. And the modified AGI for this, remember it's different for whatever credit or deduction you're looking at. Modified can mean something different. And it's $40,000, which qualifies her for a 10% credit. So she's also going to save 10% on $2,000 of the $3,000 contribution, for $200. So it's a 10% credit of $2,000. And she gets that because she has a modified AGI. So she's saving $5,600. So the after-tax cost is $3,000 minus $560 that she saves in taxes, or $2,440. So basically $200 a month, and she can be contributing to a traditional IRA. So again, you want to look at the Roth IRA. It's not tax deductible, but it has tax implications later.